Well, our next guest believes every bank should suspend its dividend. Let's bring in Sheila Bair. She ran the FDIC during the financial crisis, is now director of the Volcker Alliance. Sheila, great to have you with us.
Great to be here. Thanks for having me.
Why don't you believe what the Fed is telling us in terms of the bank's ability to pay dividends?
Well, I think that we don't know. The situation is highly uncertain. We're in a very severe situation, unprecedented, much more tougher than previous stress tests or what they were assuming in February. So I think it's just common sense to keep that capital on bank balance sheet. The best and highest use of capital right now is to stay on bank balance sheets. That way it can support lending, it can support expanded deposit taking, it can support the real economy, which is their function. I do think it's really important to understand as part of this discussion that the Fed has been providing capital relief. The Fed and other regulators have been lowering capital minimums, which makes bank balance sheets more fragile. And I understand some of that may be necessary because banks do need to expand their capacity when you get into a situation like that. But a better way to do that is to retain capital, keep those dividends on the balance sheet. That also expands lending and deposit-taking capacity without weakening the bank. And, if I'm wrong, if we get out of this just fine, then later they can do a special dividend, distribute that capital then. But right now, given uncertainties, I really think it needs to stay with the bank.
What do you think is not being factored in? I mean, do you think loan losses will be much greater than anybody thinks, Sheila?
Well, I think there's a lot of uncertainty. So first of all, there are a lot of loans that are in forbearance. Banks don't really know whether those are going to come back or not. They're not being reflected in bank capital now because basically the CARES Act said if you're in forbearance, you can't treat that as troubled debt, which is fine, but that means you don't get a higher capital charge as you ordinarily would. So we don't know a lot of those loans are going to be rehabilitated. A lot of them aren't. They've done a lot of provisioning for CECL in the first quarter. That was significant addition to loan loss reserves, but that's not deducted against capital. Usually it is. So these are all things that tend to inflate risk-based capital ratios. The other thing that bothered me about the last week's announcement was the sensitivity analysis didn't tell us what was going on with their leverage ratios. So they're only using risk-based ratios, which are important, but they have a lot of problems, and that's why, as part of the post-Great Financial Crisis reforms, we said we need a simple leverage ratio, too, to backstop risk-based measures, because risk-based measures can be unreliable. And the Great Financial Crisis everybody said mortgage securities and derivatives were low risk, and look what happened there. So they're not using the leverage ratio anymore to test the financial strength of the banks in this situation. And if you look at the ESLR, the Enhanced Supplementary Leverage Ratio, which in my view is one of the most important for the biggest banks, even in the February analysis, you saw banks like Goldman Sachs are dipping down to 3.5%. as part of the most adverse scenario. And that is not as adverse as what we're dealing with now. So I do think there are a lot of questions, in addition to the economic uncertainties, a lot of difficulty now just looking through all this and trying to figure out just how strong banks are. So again, keep that capital on balance sheets. If I'm wrong, do a big special dividend. But what we can't afford is to have banks get in trouble again, and then we not only have an economic crisis, we have a financial crisis as well, and that would be absolutely devastating for our economy.